Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, June 28, 2018. You're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. This morning, including overnight, the futures were trading down. The market opened down. However, we did have an intraday reversal, and the market actually finished positive for the day. The S&P 500 was actually up over 16 points for the day. The Dow was up about 100. The NASDAQ Composite was up about 58 points. So it finished up a positive day across the board. So the main question is, A, has anything changed? B, is there still more downside scheduled? And C, is this a reversal that we saw today, and are we just going to take off to the upside from here? So let's answer those questions to the best of our ability, see what we can come up with, what the charts are telling us as we lead into the close of June and leading into what's going to be what's called a holiday week. 4th of July here in the U.S. falls next Wednesday. So it's interesting to see whether or not we have any kind of volume in the market Monday or Tuesday. We certainly don't expect a lot of volume Thursday and Friday. I think there's a lot of vacations going on with the 4th of July and Thursday, Friday taking a nice extended long weekend. So my expectation is that we're not going to see a lot of trading activity Thursday and Friday. And Monday is a crapshoot because Monday's typically a light volume day anyway. And then you just have Tuesday, which is the day before 4th of July. So we could actually have the entire week as a washout, or the market can get its job done on the downside while everybody's not looking during the 4th of July holiday week. And there you have an answer to one of the questions is there more downside coming in this market? And I believe we have not satisfied the required downside to finish off this corrective move. And that should lead to another leg up in this market. How high? We don't know yet. It doesn't matter. We can't know that until we see what kind of reversal we get off of whatever bottom they put in. Now here's the caveat to the second part of that. The second part being another leg higher. If we finish the month of June very poorly, for example, let's say we have a down day tomorrow, that's going to be a negative sign for the market. Doesn't mean we're not going to have another leg higher. It's just going to help determine how high that leg is actually going to go. Is it going to go as high as the 280 level we saw before? And from what level is it going to come from? Is it going to be from here? Is it going to be from here, or is it going to be from a lower price down here? Anything's possible. Remember, we're looking for more downside, but we're not interested in buying the market until we see a sign and a signal of a trend reversal or a trend change. So I'm looking for in this 266.50 area. It could come up slightly short of that around the 200 period moving average, or we could spike through it a little bit and come down a little bit farther. 264 is an important number on this chart. So the main point is I still believe we have more downside work to do before this correction is over. And one of the ways that we can gauge this is, and this isn't an absolute, but it's something that we can utilize as a guideline. So if you look here from this pivot top to this pivot low was about 14 trading sessions, I believe. From this pivot top to this pivot low was about 12 trading sessions. Going over to the left, sorry to jump around, from this pivot top to this pivot low was, I think, 11 trading sessions. And from the recent pivot top through today, so far is 12 trading sessions. Is the correction over or not? Do we have another little bit more to go on the downside, another day or two? So we're in that range. It doesn't have to be 12. It doesn't have to be 11. It doesn't have to be 13 or 14. We just know that we're getting into the zone in time where the other corrections were satisfied. So we're going to begin looking for a low, whether it's tomorrow or Monday or Tuesday, something in this neighborhood, we should be finding a low. And by the way, could it have been today? Well, it's possible, but we won't know for sure until and unless we're able to close on the daily chart above yesterday's high. Remember that from last night. That's an important level. If we can close above yesterday's high, that's going to temporarily take, and potentially longer than temporary, take the downside off the table. So I think that's a reasonable guideline. As long as we stay beneath on a daily chart closing basis, yesterday's high, there should be more downside coming. Close above, and that'll be bullish for the market. We're now looking at an hourly chart, and there's a couple of things I want to point out. So you can see here this morning, we made a lower low from yesterday's low. And that's where personally I thought we were going to have lower prices today, but the market put in a reversal and we traded higher beginning about 10:30 in the morning. You see that a lot. Between 10:30, 11, 11:30, in that neighborhood is generally where the market makes a shift. If we're trading up into that time period, we generally will consolidate down for a couple of 3 hours and then potentially have another push higher to the end of the day. We've seen that over and over again. And if the market's trading down early in the morning, we generally find a low around 10:30, 11 o'clock in the morning, and then the market tends to float up for the remainder of the day, unless it's one of those hard sell days, which we frankly just don't get a lot of. They'll be back, we just haven't seen too many of them lately. Before this correction started, we've had a few during this correction, but for the last number of years, in fact, we really haven't had too many hard down days. Something else I want to point out on the hourly chart, it's interesting. When you look at the pivot high, which was from yesterday, and by the way, ironically enough, that high yesterday was made on the 11:30 candle, so that's trading between 10:30 and 11:30. This candle, we made a peak and we traded down for the rest of the day. So see, the market made a shift or a turn in that 10:30 to 11:30 time frame. And then we did the same routine in the opposite direction today. Here's that 10:30 to 11:30 time frame today. We made a bottom, reversed, and traded higher. Couple of things I want to point out on this. Number one is a lot of traders will try and short the market when the lows from yesterday were broken. That might work once in a while, but if you look at the charts without any information whatsoever, just use your eyes and go look at an hourly chart or a 10-minute chart and look and see how many times the market will dip below a prior low by a little bit and then reverse. And what I find interesting is a lot of traders are taught to short on a break of the low. And I don't know why they don't realize this, but it really doesn't work. Sometimes it works, but the majority of the time, it doesn't work. The large money players, the institutions are waiting for this to take place. They're waiting for the unassuming retail trader to short on a break of the lows. They reverse the market, rip it in the other direction. The retail trader has to cover his shorts. You get a little bit of panic buying going on, and it happens over and over and over again. And it really is beyond me why traders would continue to make this effort to try and short on a break of the lows, but it happens all the time. But the other thing I want to point out on this chart, on the 60-minute chart, something very interesting, which is when you take a look at the pivot top from yesterday, and this was yesterday candle finishing at 11:30 a.m. We traded down to 10:30 a.m. this morning, put in a, what I like to call pseudo doji candle. This is something that's discussed and explained in the course at Lazy E-mini Trader. But what's more important is the time that the market went down from the pivot top to the low this morning was an important amount of time. And this is something I discuss on various different charts every single night. It happens over and over and over again. And this is where time is more important than price. We see the markets trend for a specific period of time before putting in a signal or a sign of a trend change. That's precisely what happened on this hourly chart today. From a short-term perspective, by the way, talking about trading on Friday morning, we should expect, unless we have a significant gap higher, we should expect resistance right around this area, 272.33, somewhere in between there and the top of the breakdown candle. That's where I would expect the market to find some resistance. If it can't close above that price level, above the high of that breakdown candle, that could be the recipe for the beginning of another leg lower. We'll see what happens in the morning. By the way, I'll do my little intermission here. Thank you for making comments underneath the video. Please keep it up. I love the interaction. I love the banter back and forth. Let's talk about the market, talk about the economy, ask questions. I'm happy to get interactive. It's helpful to everybody in the community, so please continue to post comments. Also, hit the like button and share the video with those people you think can benefit from this information. Okay, taking a look at the IWM, my favorite market leading indicator. So the IWM came up just short of the 50-period moving average today. What really happened was we took a visit down to this gap window. That's where the market found support, and that's where the market reversed this morning from that price level. We should, and we will, fill this gap down here that coincides with the 50-period moving average, and it's right above the 160.63. That's an important number. On a hard sell, we can certainly come down below that and visit the upsloping trend line or in between the breakout area, 160.63, and the upsloping trend line. Also, we have a safety net underneath by the 100-period moving average. So there is a lot of support beneath the market. There's a lot of support down in that area between, let's just call it 161.52. That's the exact number of where the gap would be filled. And down here by this trend line, in between 161.52 and we'll call it 159. So in that range is where my expectation is we will be looking and seeing a signal and a sign of a trend change. Of course, that's provided the IWM does go lower. I think it will go lower. I think it needs to go lower. The sign that it doesn't have to go lower is if we close above the high of yesterday's candle. Until and unless that happens, lower prices are still on the table. Here are the transports. Now, we did come down to the bottom end of the channel that we've been talking about for quite a while, close to it, and we put in a tail candle. So the question is this a sign of an impending reversal? It very well could be. Maybe the transports are once again a canary in the coal mine in the opposite direction. Maybe the transports are telling us the market's about to find its footing, and the transports are giving us a hint ahead of time by putting in a tail candle today. We can still come down and retrace a portion of that candle. That would be at least a down day, at least initially. We'll see. A close below today's low is going to be an extremely negative sign for the transports. Right now, we're going to see if this tail candle low can hold. The low came in at 10,192. We were talking about 10,150 in that neighborhood. We were in that neighborhood today. We might not have been at the right house, but we were in the neighborhood. The Qs, technology, we had a nice bounce higher in technology today, finishing up. The Qs were up almost 0.9%. So that's an interesting scenario. The 50-period moving average is holding the triple Qs. You also have this area here where there was a former consolidation point. So we came down to visit that former consolidation point, and we bounced off the 50-day moving average. So we'll see if that can sustain or not. But again, same routine as the other charts. Any daily close above yesterday's high, downside will be temporarily off the table. Until and unless that happens, my expectation is we still have lower prices before finding a low. And by the way, just so everybody's aware, because I do get a lot of questions about what I'm doing, my positions and such, I'm not trading for the downside. I'm waiting for the reversal from the low that I believe will be put in, and I'm going to trade it to the long side. I did trade it down a couple of times, at least a couple of times, in this corrective move. But I believe we're close enough to the low where I don't want to be wrong ahead of time, and I'll leave the final leg lower to somebody else. I'm not interested in shorting the market down here. It's been down too much. Shorting at the lows is a very difficult endeavor. You're shorting what's called in the hole. Now, I might take an intraday short, but from a positional perspective, meaning a swing trade, a multi-day hold, I'm done with the short side unless the market tells me otherwise. Here's the XBD, and I want to point something out that's interesting. So the XBD puts in what looks to be a sign or a signal of a potential trend change. It's a pseudo doji candle. But we came up short of the 200-day moving average. Is it logical that the market's not going to touch, or the XBD is not going to touch the 200-period moving average? It could happen. It just doesn't normally happen that way. I'm not saying we have to. The market's going to do what it's going to do. I just think it would be a little odd to come up that close and not spike through by just a little bit the 200 period moving average. So I'm a little suspicious. I still think there's another leg or at least another portion of downside coming. Dead cat bounce in the XLF up 1.8%. That's a nice move higher in the XLF, only we were severely oversold. I mean, look at how we were down from the last pivot high beneath all the moving averages. This is the weaker market of all the markets that we look at. So is today's rally of 1.82% meaningful? Not really. If we get above yesterday's high, that might change my opinion slightly, but for now, I'm looking at it just as a dead cat bounce. You also had a similar situation in the leading tech stocks, Amazon, Facebook, Netflix, Google, even Alibaba was up today. Baidu was down. Those are two Chinese stock names. What else? Apple was up. So these stocks had a little bit of a dead cat bounce. I don't know that we can really read anything more into it than that right now until the market tells us something otherwise. Right now, I'm just not sure we're satisfied on the downside. And the challenge is going to be leading up into the holiday period, right? Are we going to have more downside tomorrow and next week leading into when a lot of people are away, a lot of market participants are on vacation, the volume is going to get extremely light? Are we likely to see a lot of downside? It can happen. It's just not normally what happens around this time period. So it is a little bit of a quandary. Looking at the SMH, the semiconductor index, we had a tremendous sell from the last pivot high in the SMH right up here. And yesterday we closed below the 200 period moving average. And today you'll notice that when we did bottom today, where did we rally to? We rallied right to the underside of the 200 period moving average, tested it and backed off a little bit. So is that just a retest and it's going to fall away again? Or are we going to power through that? But here's the interesting thing, same as all the other markets. Until and unless we close above the high of yesterday's breakdown candle, I just don't see this market has bottomed yet. It's possible. I just don't think it's probable. We made a low this morning of 100.91. I believe we have to get through a little bit of a spike through at least $100 a share. It would be unique for me to see a market come very close to 100, less than $1 away, and not come to and slightly through the big fat round number of 100. It certainly can happen. I just don't think it's likely. I just am suspicious of this market. I don't think today, this morning, was an official bottom, quote unquote, if you will. Gold continues to edge lower. Looking at the daily chart, you can see here that the low today was made at 1247 spot 20. So we broke below 1250, and I told you that 1250 to 1255 was going to potentially be supportive of the market, and if that didn't hold, then we would go down to 1230, 1235. So it will be interesting to see if this 1250 area holds. The gold chart is really, really oversold, so don't be surprised to see a dead cat bounce occur in gold. We've been down, minus a couple of days, we've been down a lot in a short period of time, from all the way up around 1313, all the way down to $1,247 an ounce. That's a big move in just over 2 weeks worth of trading activity. How about crude oil? You can see that we had another up day in crude oil today. In fact, the high today was where? You see the red line peeking through the top of the screen? The high today was $74.03, backed off of it just a little bit. Where does that line come from? It comes from the beginning of the hot zone. So we peeked our head in the hot zone a little bit today by 3 pennies and backed off. I think we have to go higher. I think we've got to get into the middle portion of the hot zone. Doesn't matter to me whether we get to 75, 76, 78, makes no difference. We're going to be looking for a signal and a sign of a trend change. Wherever the market decides to top out, I think there will be plenty of meat left on the bone for a short trade. We don't have to be the first one to the party. We just have to be at the party while everybody's having fun. In this case, the metaphor is the party is like the short side, and if you're short and the market goes down, you're having fun. Therefore, we just want to make sure that we're an invited guest to the party. That's it. So from that perspective, nothing's changed in crude oil. It's doing exactly what we mapped out for a long, long time. It's finally coming to fruition. I think there's slightly higher prices coming, and if there's not and the market reverses from here, so be it. We'll be able to identify the reversal when it happens. And with that, folks, it's everything I wanted to and intended to discuss tonight, so I'm going to give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.